Uganda's central bank has held its benchmark lending rate at 11%, citing renewed upward pressure on the rate of inflation. For more on the bank's decision, I'm joined on the line now by Adam Mugume. He's not with me yet, is Adam Mugume, so we'll try and come back to him. The vice presidents of Sudan and South Sudan have pledged to resolve a conflict over Juba's alleged support for rebels that is threatening cross-border oil flows. The leaders have, however, failed to offer any concrete solutions. Well, let's now go across to Adam Mugume, who is with us talking from Uganda and the interest rate decision. Good afternoon to you, Adam, Executive Director of Research at the Bank of Uganda. Take us through that decision there and the factors that had to be taken into account.
Oh, we did have a monetary policy meeting today. We held a constant our policy rate based on inflation mainly outlook within the next 12 months. Where the risks were balanced, the upside risk to inflation basically coming from food prices, but also the downward pressure coming from weak demand because the output is still below potential and the gap is still really not covered. The output gap is still negative for more than 1 year. So based on that, we thought that although the food prices are likely to rise, we should not preempt by increasing interest rates now, given the weak aggregate demand and also that the private sector investment and is equally still subdued at the current rate. So basically that was the basis of the decision for today.
Now, interest rates were raised in the second half of 2011 to combat inflation. That seems to have worked. And then there was a cut last month by 100 basis points. How long do you expect those cuts to take before the effect runs through into the economy?
We already, I think the problem has been really at the extent of the negative news that is coming from the global side. Given that the global outlook is still weak, I think also the sentiments are being reflected partly in the domestic economy. So you see that actually, although you're talking about interest rate, there is also equally weak demand for credit. So beneath the commercial banks were to give credit, but also there is no demand for credit. So the weakness in demand for credit is reflective of the weak perception about the economic activity. But we have already started seeing a pickup. Of now, I think we already started seeing that in the last 2 or 3 months, the net credit extension in shillings has actually been positive compared to the previous months when it has always been negative, meaning that the recoveries were greater than the extension. So already we have started seeing that. Interest rates now are already around 23.5, down from, remember we had an interest rate of 28 at one time on lending interest rate. To see that we have moved from 28 to 23, that is 500 basis points. Although the CBR was reduced by around 11, I think it is really a positive side, although we know that the space has been really quite slow.
Just looking at what the banks out there, as opposed to the Bank of Uganda, are doing, 24% is still the ruling interest rate for many of those banks. So on the one hand, you say there's no demand for credit, but at that level, surely those banks should have modified their interest rates as well.
No, but also you have to also look at the cost of mobilizing. Actually, if you look at the cost of funds, the interest rate cost, it could also actually been high. I think in the last month or so, that's why we started seeing that actually, for example, the time deposit rates now moved to around 12, 11, between actually 11 and 13. So given that you have 11 to 13 on time deposit rates, which should really be supporting credit, commercial banks with the markups and other risks, lending at 23, I think is a positive side of it. Historically, by the way, you know that Uganda has also normally had a chronic high interest rate in mineral loans, basically because of the historical aspects and also the fact that the economies of scale in terms of banking have really not really have been exploited up to the current level. I mean, we still have many people that are not really banked. So some of those factors are reflected in high cost of credit. You are right.